It's time for Yahoo Finance's Market Minute. Stocks are sliding today as investors go risk off amid escalating tensions in the Middle East. Israel launching strikes at Iran's nuclear sites, citing fears of their weapons development. Iran responding with a drone strike, calling Israel's attack a declaration of war. President Trump is urging Iran to reach a nuclear deal before it's too late. Shares of energy companies Chevron, Exxon, and Occidental Petroleum popping as oil prices spike by the most in 3 years. The conflict in the Middle East prompting concerns around the outlook for supply in the region. And we're seeing gold rise as Bitcoin falls, the precious metal maintaining its status as a safe haven asset in times of crisis and uncertainty. Meanwhile, the cryptocurrency is pulling back by about 2% as investors flee from riskier assets. That right there is your Yahoo Finance Market Minute. Scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth. I'm Allie, Canal, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, market volatility remains a top concern for investors. I'll speak to one portfolio manager about finding those resilient parts of the market in just a few moments. And Bitcoin falling as investors turn on the risk-off trade. Are crypto ETFs still a smart play in this environment? We'll get the latest on how those assets are performing. Plus, all week on Wealth, we're talking about student loan repayments. Today, we'll hear from one debt expert who paid off hundreds of thousands in just under 10 years. You don't want to miss it. But first, we take a look at some of the market action 90 minutes into the trading day. We are deep in the red as stocks plunge during escalating conflicts happening over in the Middle East. And my next guest says that with more clouds on the horizon, the need for resilience has never been greater. Joining me now is JoAnne Feeney. She's Advisors Capital Management Partner and Portfolio Manager. So JoAnne, thanks for being here. I want to start off with the sell-off that we're seeing today. We saw that Israel strike on Iran. Does this serve as a wake-up call about the global geopolitical risks still out there, even as inflation, tariffs, and those deficit concerns have really dominated the narrative as of late?
Yeah, it seems like there's an awful lot of things, Allie, that are dominating the narrative. And you're right. For a while, it was all about global political instability with Ukraine and then fears about China and Taiwan. And it's like people a little bit forgot about the Middle East. But this has been brewing for a while. It's something we've been watching, this threat. And so, yeah, I think it's a little bit of a wake up call that the story for investors is not just about tariff policy and resolution of our budget at the federal level.
Do you see this pullback as a buying opportunity, especially considering stocks have drifted towards those records that we did see earlier this year?
There's no question that, stocks have clearly moved higher. And we're at, in some places in the market, pretty high valuations. So, any opportunity, if you're not fully invested, to take, this could be an opportunity to take advantage of some of the pullbacks. Now, we're not seeing a major pullback here, right? Just, on the average is a percent, less than a percent. So, I think what investors really should be aware of is their longer term plan, whether that's a 3-year, 5-year, or 20-year, and make sure that they have their portfolio oriented towards what they most need over those time horizons. There are pullbacks that happen. If you're not fully invested, you could take advantage. I wouldn't consider today big enough to change somebody's perspective on what they should be doing with their investment strategy.
So are there certain sectors that you're bullish on amid all the volatility that we've really seen since January?
Yeah, so there are a lot of places to look. And again, depends on your time horizon. But if you're a longer term investor, right, if you have a long enough time horizon, there are a lot of growth opportunities right now in the global economy, obviously led by what's going on in the infrastructure build for artificial intelligence applications, right? We've seen a lot of that, but there's clearly more to come. I've written a couple of commentaries over the last few weeks about how AI is definitely the new growth engine. First, it was of the U.S. economy, and now we're seeing it spread globally with those NVIDIA and U.S. sponsored deals with the Middle East, but also NVIDIA being in Europe over the last couple of weeks, announcing new deals. What this is an infrastructure build. We get that first. You invest in the picks and shovel companies like NVIDIA, but then you also get applications. And then you need to go seek out which companies are going to develop those applications, whether they're products or services, that will power their growth for the next 5 or 10 years. I believe we're in the early innings. So a long-term investor should be looking to get some decent exposure, not too concentrated, but decent exposure to this as a growth engine for their portfolio.
Okay, early innings of AI. And when we talk about the macro picture too, it's interesting to see the week end on a seemingly sour note here, since we did get encouraging data this week on the inflation side of things, moderating a bit in the face of those tariffs. How do you think this positions the Fed heading into next week and really starting to assess their easing policy?
Yeah, so there's a really major and almost impossible challenge for the Fed, right? On the one hand, tariffs, to the extent that they are initiated, and we've already had some, and particularly that increase on steel and aluminum, which will percolate through lots of products that use steel and aluminum, are clearly going to increase prices. And that could be a one-time quick increase, but more likely it's a sort of price increase that is taken up by different firms across the economy only gradually. And those percolate through, they propagate into the future. So you do get an inflation uptick because of tariffs. How big that is depends on how big the tariffs are and how long they last. That increase in inflation should prompt the Fed to keep rates higher for longer. On the other hand, tariffs also reduce economic activity. They make things more expensive, not just for consumers, but for firms trying to build stuff, trying to expand. Even restaurants buy lots of electronics. They're going to be subject to potentially higher tariffs. So that economic slowdown is something the Fed would normally confront by reducing interest rates. So the Fed needs to do two opposite things at the same time, which means they will do nothing, right? Unless they figure out that one of those forces is considerably larger than the other. They definitely need to keep inflation expectations anchored. Right now, we think that's the bigger of their two goals. So we think it's very unlikely that the Fed cuts rates anytime soon.
So even if they stay on hold, we will be receiving the summary of economic projections. Those are quarterly projections. That includes the dot plot where interest rates could be heading. What are you expecting to see, and how could that change from what we saw previously?
Yeah, there's a little bit of a nuance in how people should interpret those. They're not exactly forecasts. They're really contingent upon what each forecaster is doing with their own model of the economy. But, suffice to say, it's more complicated than people realize. I believe that every member that is involved here recognizes those two opposing forces of tariffs. And also, by the way, the concern about the U.S. federal budget deficit and how much larger it looks like that's going to become, which will also put upward pressure on particularly long-term interest rates. So I think we're likely to get not a very large change, and certainly not something that would suggest cuts are coming anytime soon.
All right, JoAnne, thank you so much for those insights. Appreciate it.
You bet.
Now time for some of today's trending tickers. We're watching AMD and Chime, and joining me now is Market Domination co-host Julie Hyman. So first up here, we're looking at AMD. It's aiming to rival NVIDIA's Blackwell AI chips. The company launching its new M1 350 and detailing its next generation M1 400 GPUs at its Advancing AI event in San Jose, California on Thursday. AMD also showing off its new AMD Developer Cloud, which allows users to log into its platform to quickly gain cloud access to its line of GPUs here. So AMD does say that the processors offer up to 4 times the AI compute versus its prior next-gen chips, again, designed to go head-to-head with NVIDIA. We'll see how these chip wars continue to develop here. Shares are down right now across the broader market, though, too.
Yeah, and, yes, and they fell a little bit yesterday, even as they were making some of these announcements late in the session and then continuing that decline today. This has been going on ever since NVIDIA really started asserting its dominance. You've had these other chip makers come out and say, oh, we're making this newer, even faster chip. Does it bear out in the marketplace? We haven't really seen that yet, right? Mm-hmm. We still see most of the dollars flowing to NVIDIA, and some of the dollars that aren't flowing to NVIDIA are flowing to Broadcom because companies are getting those custom chips. So, yes, AMD has some market share, and maybe the market will be so large going forward that they'll get more, but, I guess what I'm saying is these announcements don't necessarily always have a big impact We're going to have to see how it flows through to the numbers. AMD, by the way, has really been underperforming. The stock is off like 28% over the past year. Most analysts still like it, overwhelmingly, in fact. But, you know, even this year, it's down about 4%.
Yeah, you bring up a good point, too, with just the sheer size of AMD relative to NVIDIA. It's just such a smaller company, so we'll continue to watch those developments, too. But moving on to Chime, shares are falling to start its first full day of trading. The stock closed higher by over 30% on Thursday, the latest in a series of IPOs that soared after their debuts last year. I actually got a chance to speak with Chime CFO Matt Newcomb about how the company is positioned within this volatile market environment and where he's seeing strength right now. Take a listen.
Our payments business is very concentrated in non-discretionary spend, and that tends to be resilient regardless of the macro cycle. And I think there's been a lot of headlines about worries about the economy and macro. What we see is a resilient consumer spending and a lot of behavior on our platform, very much in line with what we would expect.
So the resiliency of the U.S. consumer, that stuck out to me here. We have seen sentiment data rebound recently. Just this morning, consumer sentiment bouncing off those 3-year lows. We'll see if that reverses, depending on the headlines that we get out of Washington and, like we saw today, the world. But we are at a time when digital banking, consumer-facing fintech, that's becoming more and more popular. So I'm curious to see how Chime performs within this market, especially since the IPO landscape right now, it's been a little lukewarm.
It has, although you know what's really interesting? I was looking at some Bloomberg data this morning, and the larger IPOs that come out this morning, this year, have done really well on the first day.
Yeah.
The ones that are over $100 million on average have jumped about 25%. Now, that doesn't mean over the long term that they're going to do great, but it shows you that there is an appetite out there in the markets for these new offerings and for these larger companies in particular. As you know, the bankers keep hoping that this thing is going to crack open a little bit more. And with every incremental step of a company like Chime coming out and doing well, one would think that that would prime the pump a little bit more for more of those types of offerings.
Yeah, look at the Circle IPO.
Yeah.
That did really, really well.
Exactly.
And Chime right now is trading $34 a share. Like we said, it's off, but it was priced at $27 a share.
Exactly.
So we're continuing to watch that space. Julie, thank you so much.
Thanks.
You can scan the QR below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Coming up, choosing between Bitcoin and Ethereum ETFs, one expert breaks down the pros and cons of each one and why he thinks everyone should have at least some crypto in their portfolio. That's next on Wealth. Bitcoin sliding as investors shy away from risky assets and pile into safe havens as geopolitical conflict escalates in the Middle East. My next guest says that most investors should have at least some crypto in their portfolio, but does that put them at risk of a pullback? I want to bring in Ric Edelman. He's Digital Assets Council of Financial Professionals founder and the best-selling author of The Truth About Crypto. So Ric, let's start with today's trading action. Does this expose some of the inherent risks associated with crypto investing, especially during these periods of uncertainty and volatility?
Yeah, there's no question that Bitcoin and digital assets broadly still represent an aggressive posture in investing. But that said, we do know now we have 15 years of performance data. The volatility of digital assets is declining as the asset class matures. And in fact, over the past year, Bitcoin has been less volatile than many tech stocks. So the pullback we've seen in the past few days is the same pullback we've seen in the stock market and the bond market because of the knee-jerk reaction to what's happening on global economic environments and the recent attacks in Israel against Iran. So I don't really think that we need to be terribly worried about owning crypto any more than we need to be worried about owning stocks.
And you recommend investors allocate between 10 and 40% of their portfolio to crypto. What's driving that conviction and what makes you so confident in the longer term case there?
Well, it's a couple of things. Number one is longevity, which seems to have nothing to do with crypto. We're living longer than ever due to medical innovation, nanotech, biotech, bioinformatics, 3D printing, of course, AI and robotics. All of this is causing people to live longer than has ever happened in time in human history, which means you can't assume you're going to retire at 65 and be dead by 85, which is the way it was for your parents, grandparents, great-grandparents. Today, we need to assume that we're going to live to age 100 or beyond, and that means we need to have a far higher allocation to equities than anybody ever did before, and we need to hold those equities much longer than anybody ever did. Instead of that traditional 60-40 glide path, where by the time you're 75, you have very little money in equities, you need to have the bulk of your portfolio in equities well into your 80s and 90s. And increasingly, you need to have a significant part of those equities in crypto, the fastest growing, most profitable asset class over the past 15 years, and expected to continue to be doing so over the next 10 or 15 years. So that means even conservative investors ought to have a 10% allocation to crypto, aggressive investors as much as 40%.
And given President Trump's embrace of crypto, this proposed regulatory framework for stablecoins in Congress, are we finally seeing a clearer path forward for crypto regulation, especially now with major players like Walmart and Amazon reportedly considering launching their own U.S. stablecoins?
Very much so. The Trump administration is clearly reversing all of the blockades and obstacles that were put into place by the Biden administration. And so we now see that the SEC, the CFTC, the OCC, the Department of Labor, everybody is rescinding all the rules that had prohibited banks from trading and custodying Bitcoin for their customers. We're now going to see all of them getting engaged. You cited Amazon and Walmart in today's news. About a month ago, there's a consortium of banks, including Wells Fargo, Citi, JP Morgan, and Chase, all announcing they're building a consortium to create a stable coin. So it's already got 10% of the entire U.S. currency in circulation. And the Secretary of the Treasury just said last week he thinks it's going to grow by a factor of 8 over the next 4 years. So we're going to see a massive explosion of engagement by institutional investors, banks, insurance companies, credit card companies, major Wall Street firms, all getting heavily engaged in this asset class. And as a result, we're going to see a massive increase in crypto prices over the next several years.
Now, when it comes to actually investing in these assets, ETFs have become very popular options. Spot Bitcoin ETFs were approved by the SEC last year, but there's also Ethereum ETFs. What's the difference between the two, and what are your top picks?
Yeah, Bitcoin and Ethereum are considered like the Coke and Pepsi of crypto. Between the two of them, they have 70 or 80% of the total market share. So for people who are brand new to this, just trying to get an exposure in their portfolio, if you just buy Bitcoin and Ethereum, call it a day, you'll just be fine. Okay. And the ETFs, you can get an ETF of Bitcoin and an ETF of Ethereum. You can do it incredibly easy, simple, very inexpensive, very convenient in your existing brokerage account. You can rebalance, dollar cost average, tax loss harvest. It's the easiest, best way for most people to do it. Bitwise, BlackRock, Fidelity, and Franklin Templeton all offer Bitcoin and Ethereum ETFs. It's the simple, easy way for most people to allocate.
And Bitcoin ETFs have already seen billions of dollars in inflows. What's the performance been like for Ethereum ETFs? And if you're just adding to your crypto exposure, how should you choose between the two?
Yeah, the Ethereum and Bitcoin differ in one fundamental way. Bitcoin is largely considered a store of value, the way gold is, and artwork and real estate. It's an opportunity to put money into an asset, hold it for a long period, let it rise in value over time. Ethereum, on the other hand, is considered a commercial application. It allows businesses to operate faster, cheaper, safer, with better benefits for their customers and their investors. So Ethereum has a lot of competition that Bitcoin doesn't have. So the two of them have very different postures in the marketplace, and Bitcoin is about 2 to 3 times the size of Ethereum. So some people argue, own them equally, own an equal amount of Coke and Pepsi. Others argue that you should own 3 times as much Bitcoin as Ethereum because its market cap is about 3 times bigger. Either way, I think you'll do just fine.
All right, Rick, some great advice there. Thanks so much. Appreciate it.
My pleasure.
Coming up, I speak to 2 founders who are working to revolutionize investing for Gen Z. That's next on Wealth. Gen Z-focused wealth management platform Alinea secured more than $10 million in its latest funding round. Co-founded by former Citi and Goldman Sachs employees, the app aims to make investing accessible and understandable for Gen Z. Joining me now are co-founders Anam, Lakhani, and Halimi. Guys, thank you so much for being here. I love what you've built. You guys met in college, you're friends. What inspired you to create this app catered specifically for Gen Z?
Eve and I both interned on Wall Street, and we saw how so many of our friends just had no idea how to invest or how to get started. So we knew we wanted to build a platform that made wealth building more accessible.
And Eve, with over 1 million users now, average age of 22, 92% women, 70% Gen Z, what trends are you seeing on how this generation thinks about investing?
So first, we talk to this user base in a way that they understand. So when we get on TikTok, we're like, hey girlies, like this is how you should be investing your money. And what really resonates with them is our playlist feature, investing playlists that are based on themes or sectors that they really love.
And how does this differ from some of the more traditional institutional investors that we see out there?
So not to be all buzzwordy, but with the advent of AI, our users and Gen Z want to be told exactly what to do that's personalized for them. Every single person has a different financial profile, and our vision with Alinea is to make sure that we're giving personalized advice to everyone based on their goals and their individual financial profiles.
So is that the main difference on how this differs from platforms like Robinhood and other types of retail investing apps out there?
We've basically built an AI coach called AI Allie, and she's like your financial bestie, and she guides you on what to invest in, how much to invest every month, what to put your money in, and that personalization doesn't exist anywhere else.
AI Allie, love that name. I'm curious how AI, it's accelerated very rapidly. How do you balance the risk reward there to not lose that personal human touch?
Yeah, our goal with Alinea is to make sure that you are understanding exactly what is happening with your money. And I think the biggest gap right now with Gen Z and new investors is the lack of financial literacy, knowledge, and confidence. And that's really where AI Allie comes in to teach you and explain to you how your money's working for you.
What are the biggest questions that you hear from Gen Z investors that are just starting this journey?
What do I invest in? How much do I invest? Where do I put my money? This is how much I make. This is where I'm living. Like, give me a plan, a personalized plan for me, and help me manage it.
You guys both have backgrounds at the big banks out there. How did that help shape this app and the creation of it?
I think it was a huge realization. We saw that everyone that worked on Wall Street tended to follow a similar profile when it came to demographics, and everyone else just didn't understand all this jargon and the linguistics that come with the world of finance. And so we really wanted to break it down and make wealth building accessible to people like us and everyone around us.
Eve, how about you?
Yeah, I mean, I think on Wall Street, you see a lot of the rich getting wealthier, and we wanted to give those tools to the masses, to people like us, and that's what Alinea is doing today.
Looking ahead, what is your vision for this app and how you hope to really continue to embrace this Gen Z catered investing approach?
Our vision is to make sure that every Gen Z in the US has a way to build wealth and to really live out their dreams. Alinea isn't just a financial app. We really say it's a way to live your dreams and have the freedom you want to have, and wealth is the way to get there.
Do you see this app maybe expanding into other financial services?
Absolutely. The goal is to build more financial tools to help these Gen Z users, average age of 22, kind of grow their financial journey with us.
And what common misconceptions or fears, I guess, do you hear from Gen Z investors?
Yeah, how do I best set up my life so that I retire a millionaire? Like, what do I do so that when I retire, I have enough money or $1 million in my bank account?
Do you find that Gen Z investors, they're more curious about how to play their money? I feel like I look at my younger brother and everyone just seems so more in tuned. And I don't know if it's social media, if it's TikTok, Instagram. Are you seeing that within your own cohort?
Yeah, so what's really interesting is after GameStop, everyone knows they have to invest their money. They just don't know what's the right way to do it or how to do it. And that's really where Alinea comes in to guide you every step of the way and really personalize it to your financial profile.
So that's interesting, the GameStop, the meme stock frenzy, that really was a turning point, you think?
Yeah, I think if you go back 10 years ago, a lot of young people didn't even know that they should be investing. I think now that's really top of mind, especially with FinTalk, which is like financial TikTok and all the memes. And so people are aware, and now they need that knowledge, the plan, and the guidance, and that's what Alinea is really delivering on.
Well, this is amazing, guys. Congrats on all the success, and can't wait to check it out.
Amazing.
Thanks
Thank you.
for joining
Thank
us.
you for having us.
Appreciate it. Well, coming up, most Americans flunk this retirement literacy quiz. We'll see how we do on the other side of this break.
53% of Americans plan to pay for travel lodging this summer, according to a study from Deloitte. When asked for the top reasons to book a hotel, survey respondents said that they look for great location, room comfort, and service. And according to Hotel.com's Hotel Price Index, there are ways for budget-conscious travelers to save, even at five-star hotels. I want to bring in Melanie Fish, Hotels.com travel expert, to break down this report. We got to know what's top of mind for travelers this summer.
Well, it's no secret that everyone is really watching every dollar this summer. And for travelers booking hotel stays, that doesn't mean they're not traveling. And it doesn't mean they're looking for the cheapest stays. It means that they're laser focused on value. So today, the Hotel Price Index from Hotels.com comes out, and it really shows how and where people can get the most value in their hotel stays.
Hotels.com has both hotels and home shares. Are consumers preferring one option over the other? What are we seeing in the trends?
Yeah. Expedia Group has Hotels.com for hotel stays and then Vrbo for private vacation rental stays. And what we see is not that travelers are choosing one or the other, but that they have certain times when they want that private vacation home, when they're traveling with a group or family. And then there are times when you want a hotel stay. I'm traveling solo right now. I choose the hotel. When I'm with my family, I choose the Vrbo.
So where can travelers find good hotel deals domestically and internationally?
Here's what the Hotel Price Index is showing. In general, across the U.S., hotel prices are slightly down this summer over last summer. And in certain popular destinations like San Francisco, Atlanta, Austin, Texas, they're down almost 10%. Now, internationally, prices are slightly up, but still tend to be lower on average than in the U.S.
Now, this got our team talking in our morning meeting this morning. You have a concept called margarita math to help judge hotel costs. Break that down for us.
I love margarita math in the Hotel Price Index. Its official name is the barometer. And what the Hotels.com did is take a look at the cost of poolside cocktails across the U.S. to gauge where the best value is and if there was a correlation to hotel room night rates. In general, there is a correlation. The more you spend for a hotel, the more expensive that poolside cocktail is going to be. But if you want the best value in your poolside drinks, Nashville is the place to go. Those prices are about $5 less than the top poolside cocktail prices in LA.
You know, that's good to know. And it's also kind of reaffirming of one of the decisions I made last time I stayed in Nashville, and I chose based on the rooftop cocktails and the rooftop itself. So how can loyalty programs help you save on your trip?
Yeah, loyalty programs are key. And I can talk about the Hotels.com one in specific, because you're not only getting those lower rates, but don't underestimate the power of the perk, because it's not just about price. So VIP Access hotels on Hotels.com are offering $250 in food and beverage credit, for example, a bottle of wine in your room upon check-in. I'm on the rooftop of the Godfrey Hotel in Chicago. And of course, you're getting these views of downtown Chicago, but you're also getting 20% off on your spa services here. So power of the perks, the better rates, and then you want that loyalty currency. When people are worried about the economy, they start to spend that stored up loyalty currency. In Hotels.com's case, it's One Key Cash, which you can turn around and spend on your very next hotel stay, or kind of hoard it, store it up, and splurge on a luxury stay later on.
All right, let's get a check on the market action here. We are off of our session lows here. The Dow, though, still leading the declines, down about 1%. You're seeing the tech-heavy NASDAQ off about 0.6%, and the benchmark S&P 500 off about 0.5%. Now, we did see some positive data when it comes to consumer sentiment earlier this morning that might be helping the equity picture a little bit, but still largely risk off. We're seeing Bitcoin shares, or the Bitcoin price, I should say, lower, down about 1.6%. We are trading above $105,000 a coin. Meanwhile, crude oil is surging. We are around $72 a barrel. If we take a look at year to date here, we are heading back up towards some of that neutral pricing action and off of the lows that we saw earlier this year. But real quickly here, want to take a check on treasuries because we're seeing some sell-offs in bonds that's pushing yields higher. We're seeing the 10-year note trading around 4.4%, the 30-year bond note trading at 4.9% here. So interesting to see that given this risk-off environment. Yields, of course, have been tracking very closely. They've been moving to the upside amid some larger deficit concerns in the U.S. So we're continuing to track all of that. But again, for now, we are off of those session lows here. Well, moving on, a new report found that the majority of Americans don't know crucial information about their own retirement planning, answering just 2 out of 6 retirement-related questions correctly. Joining me now is Yahoo Finance senior columnist Kerry Hannon. So, Kerry, why is financial literacy so important, especially when it comes to retirement?
Yeah, this is huge, Allie. It's surprising and actually quite shocking that people don't know these basic concepts of what's going to determine their future. But the fact is, it really isn't that simple. And so it's important that you understand because it impacts all kinds of things. It's budgeting 101. I look at it like, what kind of income might I have coming in, which would be your Social Security? And what kind of expenses might I have going out? Meaning, how much is Medicare going to be part of the equation? Will they cover all my medical costs? And then it might even come down to some things as important as when you choose to retire, like how much longer do you need to work in order to finance the number of years you might continue to live after you step out of the workplace. So, Allie, all of this stuff comes together that makes important life decisions. And study after study shows that people who understand these concepts have the opportunity to plan and really have more successful, financially secure retirements.
All right, so let's put our viewers to the test and get into some of the questions Americans really struggled to answer, starting with how much of your healthcare expenses are covered by Medicare. Turns out it's about 2/3. So, Kerry, why is that misconception so important?
Well, yeah, because a lot of people think that, hey, it's great, I'm 65, I've signed up for Medicare, that's going to take care of my medical costs going forward. And in fact, it does not. And one study I saw shows that the average 65-year-old can expect to spend out of pocket an average of $165,000 between 65 and for the rest of their life. Now, that might be a bit large, but the fact is people don't account for some of these other medical costs that they need to have money socked away for.
Next, how likely it is that you might think it's just a few, but turns out a majority of older adults need care. Kerry, how does that expense sneak up on taxpayers?
Oh my goodness. I mean, I don't know. I went through this with my own parents, and 7 out of 10 Americans are going to need some kind of long-term care. No one wants to think about it. And in fact, you always say, I'm fine. I can live on my own. It's independently. But it happens. It absolutely happens. And here's what the deal is. Today, these kinds of costs for an assisted care place, which Medicare does not cover, nor does Medicare Advantage for a long-term care, in assisted care or memory care, Allie, this can run from $75,000 to over $100,000 a year. And this is really an exorbitant cost that most people are not prepared to absorb.
All right, Kerry, and finally, how long the average 65-year-old will live? Most will live an additional 19 to 22 years. Kerry, what's the importance on knowing your time horizon?
Oh, goodness. Okay, now you have a better shot of not outliving your money if, in fact, you get a concept of how long you might possibly have to finance, how many years you need to continue to pay the cost for. And this, once you get a beat on that, you can really adjust your spending and kind of get a grip on what's laying ahead of you. And even such simple things, and it's not simple, I understand, but it might encourage, hey, I'm going to live a bit longer. The study shows that those folks are ones that are more than likely to say, I'm going to push push back taking my Social Security benefit until I'm age 70 when I'm going to get the biggest bang for my buck going forward for the rest of my life. Not everyone can wait till 70, but it is the biggest check you're going to be able to get. So planning for longevity helps you really control your spending, determine when you're going to step out of the workplace, and also when you're going to start taking Social Security.
Great stuff there, Kerry. Keep the quizzes coming. Appreciate it so much.
Thanks.
Coming up, we get student debt pay off tips from an expert that's been through it, paying off 6 figures in student loans. That's next on Wealth. All week, we've been giving you everything you need to know about paying back your student loans. Today, we get insight from someone with experience paying back a mountain of student loan debt. Jade Warshaw, she is Ramsey Solutions personal finance expert and co-host of The Ramsey Show. Jade, you and your husband had over $400,000 of debt, $280,000 of which was in student loans. What mindset shift helped you tackle that balance head on, and how long did it take?
First off, thanks for having me. The first thought is, hey, nobody's coming to save us. My husband and I realized that pretty early on. No one's coming to forgive these loans. No one's going to swoop in and pay the balance for us. So it's something that you really have to take control of and look at those things that you can do day by day, step by step to really make an impact on your own personal student loans.
Well, let's talk about that step-by-step approach. What were the strategies that you implemented to make sure that you had the most impact?
Yeah, so finding a good financial plan is so important. And so for my husband and I, we decided on the Ramsey plan, which comprises of those 7 baby steps that a lot of us have heard of. The first step was, hey, you're about to tackle a lot of debt, so let's get a little bit of cushion, a little bit of savings to the side. So saving $1,000 first, that was an important thing. And then the next step is you do start to tackle the debt now that you've got that little cushion of savings. And the way you tackle that debt is using the debt snowball method, which is listing the debts by balance from smallest to largest. And what you do is you pay minimum payments on everything, and then whatever's left, you throw at that smallest debt. And you can find, that inspiration and that motivation every time you pay off one debt. It's like, woohoo, we did it. And not only that, but now you get to take all that money that's freed up and throw it on the next smallest debt.
So for someone overwhelmed by student loans right now, what's the very first action that they should take?
The first action that I tell people is to just stop borrowing money, right? A lot of times we think we have to do a million things at once, but the first step really is a mental step. It takes place in your own mind, in your own emotions to say, you know what? Borrowing money is the problem, and I can't solve a problem while simultaneously creating it. So I need to stop the problem at the root. The root cause is I'm a person who borrows money, whether it's for student loans or cars or credit cards. That's how I get the things that I want in life, and that's what's gotten me into trouble. So I need to stop that practice today. And so, like I said, it's a mental exercise, but it really is the first step, is drawing that line in the sand. And then from there, we can start to tackle, the debt by getting on a budget and start to work that debt snowball.
And now that student loan payments have resumed after that long COVID pause, what's your advice for borrowers trying to get back on track, especially if they've gotten used to not budgeting that in their monthly expenses?
Yeah, the first thing is to realize, hey, what happened in the past years since COVID in the last 5 years, that really was a point in time that we'll never see again, right? The government kind of extended their hand for far too long, and a lot of us did get comfortable, and we started to almost feel like we're entitled to have this extra money, and we shouldn't have to pay back the money that we borrowed and signed on the dotted line for, right? And so the first part of that is kind of taking ownership and say, hey, I kind of got a get out of jail free card for a while. That time is over. I got to take my head out of the sand, and I've got to really accept the fact that these are my loans and I have to pay them, right? So I think that's the part that a lot of Americans are struggling with is, hey, give me back the money you were giving me. Give me back the pause you were giving me. It's kind of like a moment that we can't accept, but we really do need to accept that.
And for someone that's about to head off to school, what's your best advice to help them avoid the kind of debt that you had and set them up for financial success after graduation?
Yeah, what you said is really important. You can't wait until you're about to head off to school to start making a plan for heading off to school. That really needs to start a lot earlier on in the teen years, and it's up to parents to really start those conversations early and have them often. What are the expectations around college? And I can tell you right now, the most important choice when it comes to college is the college or school that you choose. That's really indicative of whether or not you're going to be able to pay cash for college or not. And so I tell folks all the time, parents especially, tell your your kids, you're going to an in-state school because we're not paying out-of-school tuition. You're going to bump up the cost astronomically. We can't afford that. Second, let's talk about community college for an opportunity there to get your gen eds out of the way at a very low cost. And then once those gen eds are out of the way, now we can go to a state school. Let's talk about what it looks like to do work studies, to apply for scholarships, to get grants. All of these things, they're free money, and they're money that's right at our fingertips if we're willing to do a little bit of work to get it.
And now that your debt is paid off, what's your top advice for building lasting financial health and maintaining that financial freedom that ultimately we're all looking to achieve?
You know, my biggest piece of advice is the time is going to pass anyway. It's really, you know, you look at this mountain of debt and you think, oh my gosh, I could never climb that hill. I can never pay this off. But 7 years is going to pass. 5 years is going to pass. A decade is going to pass. And during that time, you really can make a lot of headway. It took my husband and I really it was 7 years total, but to really pay off that bulk of student loans, it was really about 4 years to really cut into that. And that time is going to pass regardless. So you can either be very productive or you can make a bunch of excuses and keep putting it off and putting it off. But I guarantee you, if you start today, you are going to look up 5 years from now, and that debt is going to be gone. Working the Ramsey plan, we see that the average person is able to pay off all of their consumer debt in 2 years or less. So I'm really giving you a bump to say in 5 years it's going to all be gone.
All right, Jade, great advice to wrap up our student loan week. Thank you so much.
You bet. Thanks.
Well, that's it for Wealth. I'm Allie Canal. Thank you so much for watching, and stay tuned for Market Domination. That's coming up at 3 p.m. Eastern.